afternoon, everyone. Welcome back to the third session of today's Metals Investor Forum. We're very glad you're all here joining us. I have what I think is a lovely and very exciting and interesting group of companies to present. But first, as usual, I will hog the stage and give you some of my thoughts on what's going on, why it's going on, and just my ideas about how to position yourself appropriately. So I've named my talk Building Your Bull Market Portfolio. And I'm capturing this right now, I'm focusing on this right now because a huge amount of money has come into the mining space, into explorers, developers, miners over the last 4 months. One capture that I saw said $3 billion has flowed in financings into those companies in the last 4 months. That means a lot of things. It means there's a lot more work going on, which is great. It means there's a lot more discoveries happening, obviously exciting. It also means that it's very easy to get caught up in excitement and perhaps to lose track of what it is that you're trying to accomplish and how you might best do that. So that's sort of what I wanted to go through today. So the great thing about a gold bull market is that you don't have to be an expert to really do well when a gold bull market goes on a run. There's, I think, 3 things that you do need to do. First of all, you need to, big picture, understand the forces that impact gold, and then you need to understand them and enough that you can decide confidently that precious metals are going up for some period of time, that there is a bull market underway, and that you're confident in that decision. So that's the first thing. Secondly, you have to watch those forces enough that you can be aware when the setup starts to change so that you can exit at sort of somewhere before things turn down. I don't think we're anywhere close to that right now, but that certainly is something that needs to be going on in the background. And third, you need to know yourself. And what the real things there are, you need to know how much time you want and focus you want to commit to your portfolio, and you need to know how much risk you can tolerate. Once you answer those questions for yourself, then you can set appropriate expectations, and that will help you avoid being annoyed or disappointed or frustrated because you'll understand what opportunities you're actually trying to capitalize on and which ones are not actually in your ballpark anyways. And what I said at the beginning there, which is you don't have to be an expert. It doesn't matter whether you're a trader versus an investor, whether you're speculating on discoveries or whether you're leveraging gold exposure. It all works in a good gold bull market, which is great. It just works on different timelines, and it has different risks and different needs when it comes to your portfolio. The 2 charts that I threw up here, it's just GDX is on one side, year over year, it's up 56%. That's fantastic. So that's one example of how you can play a gold bull market. On the other side, you see Evergold. It was up 300%, which makes people anxious for those kinds of gains. But you have to understand that exploration stocks are always a roller coaster, so you have to be prepared for that eventuality. So I'm going to go through point 1, which is understanding the macro forces enough to be confident that we're in a gold bull market. I'm not going to spend a lot of time on this because I'm pretty sure that that's what Eric would have spoken to quite extensively. But I do want to touch on it to make sure that we're all sort of on the same page. So the most important bull force for gold is negative real rates. We are clearly in a negative real rate environment. And the most important factor here is that that isn't going to change for a while. So this is a one capture of real rates. You can see how negative they are. And the 2 points in red underneath the chart, first, Powell, we are not even thinking about raising rates. Then he immediately said it again. We are not even thinking about raising rates. So rates are not going to go up. And at the more recent meeting at Jackson Hole, he reinforced that stance by changing their inflation target, basically saying that they're going to let inflation run hot without raising rates to counter that move, so that there's an average of 2% instead of a ceiling of 2%. Details, I know they haven't been able to get inflation much anyways. I think inflation is coming, and I don't think the Fed is going to do anything about it. Those things add together to mean that we have more negative real rates coming, and we're going to be in this environment for quite some time. And when I talk about time, look back, it took 7 years after the great financial crisis before the Federal Reserve raised rates. I, of course, don't know how many years it's going to be this time, but it's good context to remember that it took them 7 years. That's a long time. Another thing that can certainly help gold is a weaker US dollar. And there's definitely reasons to believe that the US dollar is no longer in the bull environment that it has been in for quite some time. I could spend 20 minutes speaking on this topic alone, and I certainly will not because you would all fall asleep. But I think inflation expectations are rising. There's ongoing efforts from China that are manifesting more and more each day to reduce their reliance on the US dollar, and that is very significant. There's the ballooning money supply, there's debt loads, there's trade wars. I think there's a lot of reason to believe that that factor has changed. The chart at the top does show that we are already seeing some pretty significant inflation in certain areas, especially in food. I know that I see it when I go to the grocery store and the bills are higher than they have been. Okay, another really important force for gold is the safe haven trade. And the safe haven trade is different. It has changed since the great financial crisis and all the monetary machinations that have happened since then. The underlying change here is that bonds don't give you the yield that those safe massive pools of money want. So they're forced to play the stock market for returns instead. They can't own bonds and get 7%. That doesn't exist. So they have to play stocks, but risks to the stock market are real. I'm not predicting an end to the stock bull market. I'm not an expert on that, and I don't know when that's going to happen, but the risks are very real. I mean, you can see spiking debt loads. You can see, I think this Twitter quote, I kind of love it. Imagine buying a bond that yields less than inflation from an extremely leveraged company. That's the case in America today. And so the risks are real. That's all I'm saying. So safe pools of money want to diversify their stock exposure, the stock exposure that they have to have. And gold is one of the few options for that diversification. Okay, so if you agree with me and you think that we are in a precious metals bull market, then how far does this thing have to go? Well, whether you look at, there's all kinds of metrics that you can look at for how far this market might go. You could look at investor allocations to gold. They're still really small. You could look at gains that a bull market has made, gains that the market has made to date versus past bull markets. We're still in the early stages. You could look at equity premiums, so the premiums that gold miners are getting over the price of gold, which is what this chart here shows. No matter which one you choose, the metrics all suggest that there's a lot of upside ahead, and that's sort of without trying to account for the somewhat intangible, because it's unprecedented, uber supportive monetary stance that we're in. Okay, so if you get to the point where you're saying, yes, this is a bull market, then you have to decide how you want to play it. You have to answer these sorts of questions. What's your risk tolerance? Do you like to trade or do you want to hold? Do you always tend to go for one kind of stock? Be honest with yourself. Do you really love silver miners? That's fine, but there's a lot of reason to have a diversified portfolio across the kinds of stocks that are available in our space. So if you want to answer some of these questions, know thyself. First of all, think about risk. It's easy to see discovery hits, to see a share price spike and think to yourself, oh, I so wish that I'd been in on that. And of course, we all wish that we had a 300% gain in our portfolio on a particular stock. It's fine, except you really need to put that risk in some context. First of all, don't let the seeming flood of discoveries that we're seeing in news releases make you think that it's gotten any easier. It has not gotten any easier. It just turns out that there's more companies exploring because more companies have been able to raise money. That's great. But the odds of success on any single exploration program have not increased. They remain very low. And so don't take your low risk money and throw it into exploration stocks because it looks like more discoveries are happening. The barrier to success is still really high. And then the geologic success is sort of only one part of it. There's all kinds of risk involved in exploration speculation. Are there permitting challenges? Is there an exploration season or access or logistical issues? Is speculation or marketing campaigns influencing the share price? If so, what are you going to do about that? Then what are the results? And is there ability to follow up if the results are successful? So bottom line here is discoveries are difficult. And even when they happen, it doesn't actually get a lot easier from there because you need to follow up and there's all kinds of pressures on the stock. So then that brings you to the next question. Are you willing to trade? So this is I don't even remember which share price this is, to be honest, whose stock chart this is. It's a Golden Triangle Explorer, I believe. But the point that I put here is that there was clearly an initial discovery hit that sent the share price up dramatically. That's great. But then you can see seasonality in action. You can see subsequent disappointment about subsequent results playing out. You can probably see impacts from financing free trade dates playing out. There are a multitude of pressures that exert on exploration stocks, whether they've hit into a discovery or not, and they get amplified if they have hit into a discovery. So it just means that if you want to play exploration stocks, that's great. There is a lot of exciting projects out there that have good odds of success because these projects have been assessed and refined through a long bear market. So I would say that the targeting is perhaps above average right now. But you have to be willing to pay attention to all the forces that impact. So if you look at this share price chart, it's tempting to look at it and think, oh, I could have had a six-bagger. But would you have sold at the top? Or would you have held on because you thought it was going to keep going? Would you have played seasonality? Would you have watched the free trade pressures? Would you have modeled the drill results to see if the zone was developing appropriately? Would you have not gotten attached to the stock? It's not easy. That's my message. Exploration stocks offer incredible opportunity for gains, but it's not easy, and you have to make hard decisions with them all the time. If you don't want to play the exploration side of things, that's okay. There's lots of other ways to get exposure to the gold space. I'm not going to go through these in detail, but you can own Barrick Gold. You can own mid-tier miners that offer you both the scale of equity that attracts big pools of money. Lots of big funds can only invest in stocks that have a minimum market cap. So you can attract that kind of, invest in a stock that has that kind of opportunity flowing into it while also having a good growth profile. You should probably own some royalty companies. I mean, they're the lowest risk way to play gold, and they have outperformed miners in all of the recent segments of the market. The second half of the last bull market, definitely through the bear market, and in the bull market that we're in so far to date. So there's not really a lot of argument against owning royalty companies. These are considerations that you should make. Optionality plays, huge projects get actively pushed aside. They get actively hated in a bear market because they're expensive. They're big, they're expensive. So nobody can imagine laying out that kind of cash. But once miners get confident enough in a bull market that they start buying the assets that they need to stay big in the future, suddenly everyone starts chasing the few assets that are around. That's the magic in an optionality play. They leverage, they just ride along with a rising gold market until suddenly they become the thing that everybody wants. That's why it's called optionality. There's the two paths and they both work. You can try and identify takeout targets. The great thing about takeout targets, hard to pick them, but by definition, you're picking assets that are really good. So they should do well whether they get bought or not. You should make sure you have exposure to silver. You should make sure that you have development projects. You should make sure you have a whole raft of different kinds of projects offer opportunity in a bull market. And that's sort of the message that I want to take home, which is simply that it's very easy to get enamored with exploration stocks, and that's okay. I love exploration stocks. I probably have more than is healthy in my portfolio. But if you're going to play that game, you have to be willing to take on the roller coaster ride that is inevitable. So don't bemoan missing this. Obviously, we all want this in our portfolio, but you can't be too upset about missing this unless you're also willing to deal with this, okay? I love explorers. I've dealt with this sort of pattern all the time. The take-home message is it's rare to make a discovery. It's even more rare for a discovery to turn into a meaningful deposit, and stock price pressures along the way make profiting from these discoveries even harder again. There will absolutely be great gains in explorers. We've seen a bunch already in this market and even just in the last few weeks and months. But if you want to play the exploration stock and you want to cash in on some of those great gains, you need to be knowledgeable and you need to be focused and you need to do at least some trading. So we're set up for some really exciting years in gold and silver. I firmly believe in that. Corrections, if you want to call gold's current price performance over the last few weeks a correction, I think that's probably a fair statement. They are absolutely part of the process. Gold rocketed in July and nothing can move that. I mean, it almost looked parabolic. Nothing can move like that without a bit of a setback. So they're part of the process. It's not worrying to me in the slightest because the fundamentals of negative real rates, of a safe haven environment that really pushes people to pushes big money towards gold. It's big money that creates gold bull markets, and they are being pushed towards gold whether they like it or not. A weakening US dollar regime and inflation coming. I really think we're set up for a strong gold bull market. You just have to consider how you're going to play it. How much focus do you want to commit? How much risk do you want to take on? Figure out your answers and then build a portfolio that works for you, and then stick to your plan, because then you're less likely to be annoyed at yourself or frustrated when you miss that stock that pops, if you're aware that you don't actually want to deal with the choices and pressures that are involved and the risks of failure that are involved in investing in those kinds of stocks. And if you do want to invest in those kind of stocks, the main thing is don't get too attached. Keep the odds of success in mind, and remember that there are lots of pressures that exert on share prices. So you have to do at least some trading to manage the risk that is inherent.